Today's topic is performance measurement. As we know that performance measurement can be asked by the examiner for in the last year, our division's controllable return on investment was 25% and its controllable profit was 80,000. The cost of finance to the division was 18%. What is the controllable residual income in the last year? Now, what is the formula of the residual income? Residual income is equal to controllable profit minus expected profit, or you can call it notional profit. Here he is saying that our controllable profit is $80,000. So we have $80,000 minus notional profit. Notional profit is not provided in the question. So now we can calculate notional profit is equal to capital employed. Capital employed is not provided, multiplied with cost of capital, and the cost of capital is 18%. So it means now we need to determine controllable investment or capital employed. So now we will use the formula of ROI. ROI is provided 0.25 is equal to controllable profit 80,000 divided by controllable investment, which is X. So now you can calculate X by replacing X with the 0.25. 80,000 divided by 0.25, we can calculate our return on investment. We can calculate our controllable investment, which is $320,000, or we can call it capital employed. So now this X is replaced by $320,000 multiplied with 18%. So it is 57,600. Now we will deduct our notional profit from the controllable income to determine residual income. So you can deduct this amount for 80 from 80,000 and you have a residual income of 22,400. So this question is not the straight one in which we can calculate residual income. This is the question which provided us the information of controllable profit, because we are required to use this controllable profit percentage to determine our investment. Now on the basis of investment, we can calculate our notional profit and then we determine our residual income. Right? Any question? Okay. A government body uses measures based on the 3 E's. 3 E's is basically the concept of value for money. Whenever we are measuring the performance of not-for-profit seeking organizations, or we are calculating the performance of government organizations or public organization, we always use the concept of 3 E's. 3 E's says that there are 3 different E's. First one is economy. Economy means lowest possible cost without the affecting quality of product or service. Second E is efficiency. Efficiency means output must be maximum against input. It means losses must be lowest possible, or ideally there must not be no loss. Our input and output must be equal to each other. And effectiveness means target is achieved. Externality is not part of the value for money. So now we know that we are talking about these three. To measure the value for money generated by a public funded hospital, which means a government managed hospital, it considers the most important performance measure to be cost per successfully treated patient. Which three E best describe the above measure? Now, apparently, it says that you are required to use what, or you are discussing what? You are discussing the cost. You want to calculate what? You want to calculate the cost, basically, that what would be our cost for each bed or cost for each patient treated successfully. But in fact, at times we are talking about the cost, but our objective is not to calculate the economy. Our objective is calculate the efficiency. We want to know, or we want to determine what would be the efficiency of our this particular service, or what would be the out of this particular service, because we are consuming cost for it, or we are paying cost for it. For example, if we talk about a transport service, if we talk about a bus, and a bus has 40 seats, if a bus is completely occupied, all 40 seats are occupied, now we can say that this bus is performing at maximum possible level, or performing at efficiency. So, what does it mean? At times where you are talking about the cost, or question is discussing the cost, but in fact, main objective of the question, or main answer of the question is not cost. As I told you that economy means lowest possible cost. Most of the student thinks that answer of this question is economy, but in fact, answer of this question is efficiency, because we are talking about public funded organization which is obliged to utilize the taxpayer funds in an efficient way, and their cost for each successful patient must be lowest possible, and they should utilize the government bed capacity at its optimum or maximum level, because whenever they will use their bed capacity at maximum level, and they will try to treat their patient as soon as possible, if it will give them opportunity to treat other patients. So efficiency is a measure, economy is not a measure. Clear? Any question? Okay. The next one is, a government is looking at assisting hospital by reference to a range of both financial and non-financial factors. Range of financial and non-financial factor means what? Government wants to provide budget, government wants to provide appropriate resources, and responsibility of the government is to provide quality services or quality health services as well. One of which is survival rate of heart bypass operation. It means how many people are coming to the hospital for the bypass, and either their bypass will be successful or not, or most of them must be successful treated by the hospital. So whenever you are determining any objective, now you have an objective, you want to determine your survival rate or success rate. So objective is always measured by the effectiveness, and we are trying to learn, or we are trying to determine the effectiveness of this service. So here the answer is effectiveness. Any question? Okay, which of the following is would not be appropriate for a cost center? Which one of the measure is not appropriate for the cost center? Whenever we are talking about a cost center, cost per unit is definitely an appropriate measure. Contribution per unit is not an appropriate measure for a cost center. It is an appropriate measure in the short-term decision. It is an appropriate measure in the marginal costing. We can use contribution over there. Rest of the three measures are the appropriate measures of the cost center. Composite of actual labor cost to, comparison of actual labor cost to budget. Yes, it is a responsibility of the cost center. Under or over absorption also falls under the job of the cost center. Next one is our government is looking to assessing state school by reference to a range of both financial and non-financial factors. Which one is average class size? Now, this time we are although talking about financial and non-financial factors just like the previous question, but it does not mean that we will say that correct answer is efficiency because we are not determining any objective. Suppose if we are going to determine an objective that what would be the pass percentage of each class out of the total students, then we can say that if we are measuring effectiveness. We are saying that one of which is average class sizes. Class sizes means either we are fully utilizing the capacity of the class sizes or we are utilizing or we are not utilizing our capacity, means capacity is underutilized. If capacity is properly utilized, we can say that we are performing efficiently. But if capacity is underutilized, we will say that we are not performing in an efficient way. Any question? Okay. For operational purposes, for a company operating a fleet of delivery vehicle, which of the following would be a most useful? Now it is a delivery vehicle. So delivery vehicle is relevant what? Delivery vehicle is the one which is not only required to deliver the goods, but they will also calculate their cost per ton per mile. Cost per mile is incomplete because it is not carrying ton. Cost per driver is not appropriate measure for the delivery vehicle. Maybe possible it will be an appropriate measure wherever driver is the main cost factor or driver is the main cost reason. Cost per kg carried could be an appropriate measure if we say that cost per kg carried per mile. But this one is incomplete, so that's why it is incorrect. Correct one is cost per ton per mile because it is considering ton and area covered both. Weight and area both are relevant in the fleet of delivery vehicles. Any question? Okay. A division has a residual income of 240,000 and a net profit before imputed interest of 640,000. If it uses a rate of 10% for computing imputed interest on its invested capital, what is its return on investment to the nearest whole number? So he is saying that your residual income is 240,000. A net profit before means your controllable income is 640,000. So what does it mean? What was your notional profit or imputed profit? Your notional or imputed profit was 400,000. And he is saying that 10% is your required rate of return or your cost of capital. So you are saying that my notional profit is $400,000 is equal to my capital employed is missing because to calculate return on investment, to calculate ROI, I need profit. My profit is 640,000 divided by capital employed or controllable investment, which is X, multiplied by 100. So capital employed is X multiplied with 10%, which is our cost of capital. So now what can I do? I can calculate my return on my controllable investment by dividing 400,000 with 0.1. My answer will be 4 million. So after determining controllable investment, I can calculate ROI 640,000 divided by 4 million into 100. So you can calculate what would be your return on investment. Your return on investment is 16%. Right, everyone? Any question? Okay. Next one is JKL Incorporation budgeted to make 1000 units in May using 2000 hours of direct labor. Budgeted to make 1000 units in 2000 hours. So you can calculate budgeted hours per unit is equal to 2000 divided by 1000. It is 2. Actual output was 1100 units, which took 2300 hours. So actual hours are this and actual output is this. What is the production volume ratio? Production volume ratio is basically is equal to total standard hours divided by total budgeted hours into 100. We are provided with the information of total budgeted hours, but we are not provided with the information of total standard hours. So that's why we will calculate total standard hours is equal to budgeted hours per unit multiplied with actual activity level. So we have 2200 as total standard hours. So now we can calculate what? We can calculate our productivity volume ratio, which is 110%. Right? Any question? RL Incorporated budgeted to make 200 units in June with a standard labor hour usage of 0.6 hours per unit. Actual output is 180, which took at 126 hours. What is the efficiency ratio? Efficiency ratio is basically is equal to total standard hours divided by total actual hours into 100. Now the total actual hours are 126, but again total standard hours are missing 0.6 into 180 units. Standard hours per unit into actual units. So it is 108. So 108 divided by 126 into 100. So we can calculate what? Efficiency ratio, which is 86%. Any question? Okay. Then we have capacity ratio. CAP Incorporation budgeted to make 50 units in July with standard labor usage of 1.2 hours per unit. Actual output was 49 units, which took 61 hours. So what is the capacity ratio? Capacity ratio is equal to total actual hours divided by total budgeted hours into 100. Actual hours are 61 divided by budgeted hours per unit is 1.2 and units are 50. So to calculate total budgeted hours, we will multiply budgeted units with the budgeted hours per unit. So our hours are 60. 61 divided by 60 into 100. It is almost 102%. This is the answer. Any question? Okay. H8 PLC monitors percentage of the total sales that derives from products developed in the last year. Which part of the balance scorecard is Meyer classified under? We produced a product when we produced a new product in the last accounting period. So you produced a new product at the last accounting period and you wanted to know that how much revenue was generated by the new product. So new product is part of the learning perspective, or we can call it innovation and learning perspective. Financial perspective focuses on return on investment. It focuses on residual income. It focuses on cash flow. Customer perspective focuses on quality. It focuses on customer complaints. It focuses on timely delivery of goods. It focuses on repeat business. It focuses on new customers. Internal perspective aim is to reduce machine time per unit. Its aim is to increase internal efficiency as much as it can. And learning and perspective, or innovation and learning perspective, deals with the output of the new product or innovative product along with its revenue in the relevant accounting period. Right, everyone? Any question? Which of the following KPI? KPI stands for key performance indicators. For example, if I talk about restaurant, that what would be the key performance indicator or critical success factor will be for a restaurant. So for a restaurant, you will say that quality food or taste of the food is a critical success factor. So this is called what? This is called key performance indicator and critical success factor. To assess the liquidity of the company, liquidity means cash or cash equivalent, and liquidity of the company is measured by what? Liquidity of the company is measured by only with the current ratio and asset test ratio. Return on capital and gross profit can be are a measure of financial measures or financial key performance indicators. Gearing ratio is also a measure of financial risk. So these are the measures of profitability. And asset test ratio and quick ratio are the measure of liquidity. Current ratio is also a measure of liquidity where we calculate how much assets we have in comparison, or how much current assets we have in comparison with the current liabilities. Any question? KAPLAN has calculated the following indicators: return on capital employed, training cost as a percentage of total cost. Which of the balanced scorecard perspective would these measure to? Return on capital employed is definitely a financial measure. So there are three financial measures. It means C is completely incorrect. The other one is training cost as a percentage of total cost. Although apparently it looks that it is a financial measure because we are calculating training to a cost in comparison with the total cost, but it is not a financial measure. So CA is not the right answer. Training cost basically will contribute in what? Training cost will contribute in innovation. It will contribute in growth. So that's why, or bringing new product in the market. So that's why from the balanced scorecard perspective, return on capital employed is a measure of financial, and learning and growth will use what? Learning and growth will use training cost as a percentage of total cost. Any question? Okay. Next one is Area 27 are a pizza delivery company and have asked you to suggest some performance indicator that could be used to measure a customer perspective and an internal business perspective of the balanced scorecard. Which of the following would be appropriate? Number of customer complaints, definitely it is a customer perspective. Cost per pizza is a financial perspective. Number of late deliveries is a customer perspective. Cost of delivery vehicle is an internal perspective. Then we have internal time taken from order to delivery pizza is completely an internal perspective. Time, cost of time spent on training, it is not relevant with the customers. Profit per pizza is a profit measure. Gross profit percentage is a profit measure. So the correct answer is A, where focus of the customer perspective is to evaluate the complaints and internal perspective is to deliver the pizza as soon as possible or within the committed time. Any question? Next one is, what is the company's current ratio to the nearest two decimal places? Current ratio is basically what? Current ratio is current assets divided by current liabilities. It is not multiplied by 100, that's why it is shown in times. Whenever you multiply with the 100, then you will show in percentage. So what are the current assets? We have two current assets, these here, sorry, three current assets. And then what are the current liabilities? Here we have two current liabilities. You can add up 150 plus 300 plus 25, 475. And your current liabilities are what? Your current liabilities are 320. So you can calculate 475 divided by 320. What would be your current ratio? Your current ratio will be 1.48 times. It means your current assets are 1.48 times greater than the current liabilities. Ideal current ratio is 2:1. It means your current assets must be twice of your current liabilities. Our next requirement is, what is the quick ratio? Quick ratio is also called asset test ratio. It says current assets minus inventory, because inventory is not quickly cash convertible item, divided by current liabilities. So the current assets are 475, but we will deduct inventory from it, and inventory is for 150 divided by current liabilities of 320. So the quick ratio is what? Quick ratio is 1.02. So B is the right answer. Any question? Then we have, what is the receivables payment period? Receivables payment period is equal to receivables divided by credit sales into 365 days, or 360 days if provided in the question. So here we have what? Here we have receivables of 300,000, I think, and these are the receivables. And our revenue is 2.7 million, and we are assuming that the whole revenue is credit sales. So 300,000 divided by 2700 into 365. So you can calculate your days. Your days are 40.55. So we can say that 41 days. Any question? Then we have payables payment period is equal to payables divided by credit purchases. If credit purchases are not provided in the question, then you can use cost of sales as a second measure into 365. So payables are what? Payables are 230 and cost of sales is 1300. 230 divided by 1300 into 365. So you can calculate days. It is almost 65 days, 64 point something. So you can call it 65 days. Any question? Then we have inventory holding period is equal to inventory or closing inventory divided by cost of sales. If cost of sales is not provided, then you can calculate credit purchases into 365. So your inventory is 1500 divided by the cost of sales is 1300 into 365. So your answer will be 42 days. Then we have the next question. What is the return on sales? Return on sales means operating profit, or here we can say net profit divided by sales into 100. So what is the net profit? Net profit is, in fact, we are provided with the operating profit, so we will use operating profit, the correct measure, and sales is 2700. So 550 divided by 2700 into 100. So what is the return on sales? It's 20.3%. Then we have interest cover. Interest cover is equal to profit before interest and tax, or you can call it operating profit divided by interest or finance cost. Now, what is the profit before interest and tax? Profit before interest and tax is 550 and finance cost is 75. 550 divided by 75. So what is the interest cover of the company? 7.33 times. C is the right answer. Next one is, what is the gearing ratio total debt divided by equity? Total debt divided by equity. Total debt basically here means long-term debt. So the long-term debt is 16,000. And what is the equity? Equity is basically what? Equity is your share capital. It includes your revaluation reserves, and it includes your retained earnings. So you can add up these values. Sum of these values is 38,512. So you can calculate 16,000 over 38,512, sorry, 512, and it is multiplied with 100. So what would be your answer? Your answer will be B, 41.5%. Any question? Then once again we have current ratio. I hope now you can calculate the current ratio. You have learned the formula. You can calculate quick ratio. It is already done. Then we have return on capital employed. Return on capital employed is equal to operating profit or profit before interest and tax divided by capital employed. And capital employed is equal to what? Capital employed means equity plus long-term loans. One formula is equity plus long-term loans. Other formula is non-current assets plus current assets minus current liabilities. Capital employed is also called net assets multiplied with 100. So what is the operating profit? In this question, profit before interest and tax is this one, 27,657, and it is your equity, it is your long-term loan. 27,657, 27,657 divided by 13,512 plus long-term loan 16,000 multiply by 100. So you can calculate what would be your answer. Your answer will be D. We have already determined receivable days. Same formula will be used. Gross profit margin, gross profit percentage is equal to GP divided by sales into 100. And what is the GP? GP is 1250. Sales revenue is 2250. And it is multiplied with 100. So what is the answer? This one is the answer. We have already determined return on sale. Same formula will be used. Same for current ratio, current receivable days, payables, inventory turnover in days. Same inventory days is used. Next one is again the same kind of question which we already did. Okay. Now we have the new kind of a question or new type of a question. A division of a company has a capital employed of 2 million. Its return on capital is 12%. It is considering a new project on requiring capital of 500,000 and is expected to yield profit of 90,000 per month. The company's interest rate is 10%. If the new project is accepted, what will be the residual income of the division B? Residual income is equal to operating profit minus notional profit. And notional profit is equal to what? Notional profit is basically capital employed into cost of capital. Capital employed is 2 million and cost of capital is 0.12, which means 12%. So 12% of 2 million is what? It is 240,000. Now we are expecting total profit in addition of 240,000. Total profit is 330,000. And our total investment has become, or total net assets are 2 million previous plus 500,000 new, so 2.5 million. Now we can calculate residual income. Company's interest rate is 10%. Now the revised interest rate is, or notional cap profit is, or cost of capital is. So 330,000 minus 2.5 million into 0.110%. So you can calculate your residual income after incorporating the new project. It will be $90,000. Any question? Okay. Then we have efficiency ratio. We have already determined the efficiency ratio. Suppose if you are unsuccessful to determine the answer of this question, then I will suggest you leave it. Do not invest too much time on it. Same is the formula of for this question. Productivity volume ratio is calculated by what? Productivity volume ratio is the one where we use standard hours for the actual output divided by budgeted hours multiplied by 100. The direct labor capacity ratio for the period was 104. What is the formula of capacity? Total actual hours divided by total budgeted hours into 100. So it means your total actual hours are being greater what? Being greater than the budgeted hours. So what is the right answer? A is the right answer. If it is less than 100, then we can say that actual hours work being less than budgeted hours. Standard time for the actual output, this measure is a measure of efficiency ratio, and it is also a measure of efficiency ratio. Any question? Okay. The next one is green. Division is one of the many divisions in the color group. At its year end, the non-current asset invested in green were 30 million and the net current assets were 5 million. What is meant by net current assets? Net current assets is equal to current assets minus current liabilities. Included in this total was a new item of plant that was delivered 3 days before the year end. This item cost $4 million and had been paid for by the color, which had increased the amount of long-term debt owed by green by this amount. The profit earned in this year by green was 6 million before the deduction of 1.4 million of interest payable to color. What is the most appropriate measure of ROI for the green division? Okay. Now what will we do? We will follow the formula of return on investment. What does it say? It says that you have 30 million already in non-current assets. You have net current assets of 5 million. During the year, you invested 4 million. Whenever we are measuring the return on investment, we should use the beginning investment. So to calculate return on investment, we will deduct 4 million, which we invested almost near the year end. It is not part of the beginning investment. And what is our profit? Profit before interest and tax is what? We have a profit of $6 million. So the 6 million is divided by 31 million into what? Into 100. We can calculate return on investment. So what is the return on investment? B is the right answer. Okay. Division M has produced the following results in the last financial year. Net profit of 360,000, capital employed of non-current assets 1.5, net current assets is 100,000. For evaluation purposes, all divisional assets are valued at original cost. Division is considering a project which will increase annual net profit by $25,000, but will require average inventory level to increase by 30,000 and non-current asset to increase by 100,000. There is an 18% capital charge or investment. Given these circumstances, will the evaluation criteria of ROI and residual income motivate their division and management to accept this project? Okay. For the acceptance purposes, we need to know what we were earning already and what we will earn after this investment. So our net profit is what? Our net profit is 360 and already we have assets of 1600. So I can calculate my return on investment, current return on investment, $360,000 divided by 1.6 million in 200. So what is ROI percentage? ROI percentage current is 22.5%. Now he is saying that you will earn additional profit of what? 25,000 after making investment of these two investments 130,000. So your new profit will be 385, 360,000 plus 25,000 divided by 1600 plus 130,000. So you can say 1,730,000 in 200. So what is your return on investment after this project? It is falling. It is 22.3%. Now we will calculate what? We will calculate residual income today. It is 360,000 minus 1.6 million into 18% cost of capital. So you can calculate residual income. Now residual income now is 72,000. And the revised one 385 minus 1730 into 0.18. So it is 73,000. Residual income is rising after investment, but it is falling. So from the perspective of ROI, no, but from the perspective of residual income, yes. Any question? Okay. Which of the following performance indicators could be used to measure the quality of a service? Quality of a service can be measured by number of complaints, two, and it is measured by customer retention. How many customers are repeat business or purchasing our product once again? Next one is which balance scorecard perspective would be the performance indicator? Training cost as a percentage of total cost come under. We have already discussed that it comes under learning and growth. A company wants to measure performance under internal perspective of the balance scorecard. Which of the following would be appropriate measure? We are talking about internal perspective. And the internal perspective is not ROI, it is a financial. Warranty claims is a customer perspective. New product is internal and innovation and learning perspective. And labor capacity ratio is internal perspective because it is relevant with the internal efficiency. Which two of the following would be suitable measure of resource utilization for a private sector college? Resource utilization means number of customers served by employee or served by each employee. Resource utilization is also called sales revenue generated by each employer. So average class size, because it is relevant with number of customers served by each employee, and as well as it is relevant with sales revenue. Tutor grading by student, it is not part of the resource utilization. Pass rate is not. Percentage room occupancy, how much room is occupied. So what does it mean? It means number of customers served by each employee. So these are the two measures. Any question? A business is concerned that not all the employees are making the best use of their time. Considering the following information, there are four departments: budgeted operations, actual operations, budgeted employees, and actual employees. Which department is making the best use of employee time when compared to budget? So you can calculate number of operations done by each department. For example, here for the department A, we have 800. It is by 4, it's 200. 1000, it is by 5, 200. So budget and actual is same. 700 divided by 5, you can calculate 700 divided by 5, it's 140. 660 divided by 3, it's 220. Department B is better than them. Then it is divided by 8, it's 150. It is divided by 7, again it is same, 150. This one is divided by 4, it is 75. This one is divided by 5, it is 80. So which one is performing well? Department B is performing well, because its budget is to serve 140 operations, but they are serving 220 operations.